Gold just shattered all records again. $3,500 an ounce. Yet something doesn't add up. The general public? They're not buying. Gold coin sales are down. Silver purchases are down. Dealer activity is sluggish. So who's driving this historic rally? And why now? Why are central banks accumulating gold at the fastest pace since the 1960s? What do they know that you don't? Did you miss the golden opportunity? Or is this just the beginning of something much bigger, perhaps the greatest wealth transfer of our lifetime? Welcome to Capital Uncovered. I'm Ricardo, and today we're exposing the gold conspiracy hiding in plain sight, and why the real gold rush hasn't even started. Historical context. To understand what's happening today, we need to travel back in time. Year 2000. Gold sits at $250 an ounce, ignored and forgotten. The dot-com bubble has everyone chasing paper profits. 2008. As markets collapse during the global financial crisis, gold finds support at $700. 2015. Gold bottoms at just over $1,000 during a period of perceived economic stability. Early 2023. Gold trades at $2,000 beginning its current ascent. May 2025. Here we are at $3,500. At each of these moments, the same question was asked. Is it too late to buy gold? And at each point, the skeptics were proven wrong. But this time feels different, doesn't it? This time, the price seems truly excessive. This psychological barrier, this feeling that you've missed the boat, is precisely what keeps the average person from building real wealth. It's how the elite maintain their advantage. Because contrary to what financial media wants you to believe, gold's current rally is not being driven by retail panic or mainstream FOMO. The data tells a completely different story. One that might shock you. Section 2. The real buyer. Since the 2008 financial crisis, there's been a dramatic shift in who's buying gold. Western central banks were net sellers for decades. But that all changed after the collapse of Lehman Brothers. Look at this chart. Central banks, particularly in Asia, have been steadily accumulating gold reserves year after year. China, Russia, Turkey, India, they've been consistent buyers. But 2025 is different. Central bank buying has gone parabolic. In fact, the first quarter of this year has already surpassed the entire previous year's purchases. Ask yourself, what do central banks know that the average investor doesn't? But it's not just central banks. Something extraordinary happened in China this April. Chinese gold ETFs saw more inflows in the first 11 days of April than the entire first quarter combined. 29.1 metric tons in just 11 days versus 23.5 tons in the previous 3 months combined. And there's more. In February, China made a pivotal policy change, allowing insurance companies with their trillions in assets to invest in gold for the first time. This isn't retail money. This is institutional. This is whale money. This is smart money positioning before the masses catch on. Section 3. The insider advantage. Throughout history, those with power and connections have always moved first. The public only learns when it's already too late. In April of 2024, NASDAQ call options mysteriously spiked just minutes before a 90-day tariff pause was announced. Those with insider knowledge made fortunes overnight. Is it any different with gold? The evidence suggests not. The massive capital flows we're witnessing aren't random. They're coordinated, deliberate. And they're happening before the general public even recognizes what's unfolding. For decades, gold flowed from west to east, but in recent months, something unprecedented occurred. That flow reversed. Suddenly, Swiss refineries stopped selling to China and instead diverted supply to the United States. Why? What changed? Some speculate it's related to rumors about auditing Fort Knox, America's gold repository. Others point to geopolitical tensions and the positioning for a new monetary system. Whatever the reason, one thing is clear: the smart money is moving, and they're not telling you why. Section 4. Gold's true value proposition. For over 5,000 years, gold has been mankind's ultimate store of value, not because of tradition, but because of mathematics. Unlike every fiat currency ever created, gold cannot be printed. It takes enormous energy, resources, and time to extract just 1 ounce from the earth. All the gold ever mined throughout human history would fit in just 2 Olympic-sized swimming pools. Compare that to today's global financial system, where trillions can be created with a few keystrokes. According to investment veteran John Hathaway, gold is still severely underpriced relative to global financial assets. In 1980, gold represented 8% of global financial assets. Today, just 1.4%. For gold to simply return to its historical role in the financial system, the price would need to increase by at least 5.6 times from current levels. That would put gold at over $19,000 per ounce. Sound impossible? Consider this. Since gold last peaked in 1980 at $873 per ounce, the above-ground gold supply has roughly doubled. But in that same period, U.S. government debt has increased by 42 times. When viewed through this lens, gold isn't expensive. It's perhaps the most undervalued asset on the planet. Section 5. The public's absence. If gold truly has such potential, why isn't the public rushing to buy? According to recent surveys, 75% of financial advisors have little to no exposure to gold in client portfolios. Less than 1% of assets. This is the highest level of non-participation since 2019. No one is recommending more than a tiny allocation to precious metals. In fact, most advisors recommend zero exposure. This is exactly how wealth transfers work. The masses are kept distracted while the powerful position themselves accordingly. Look at the COMEX, where gold futures are traded. For years, it operated as a fractional reserve system, with hundreds of paper claims for each physical ounce available for delivery. In 2016, there were over 500 paper claims for each ounce of registered gold. Today, that number has fallen to just 2 to 1. The fractional reserve gold system is collapsing. Physical gold is being accumulated and removed from the system at an unprecedented rate. And still, the public remains unaware. Section 6. Historic patterns and projections. Throughout history, gold and financial assets have maintained a cyclical relationship. When stocks and bonds are overvalued, gold tends to be undervalued, and vice versa. The Dow-to-gold ratio, how many ounces of gold it takes to buy the Dow Jones Industrial Average, tells this story clearly. After the 1929 crash, the ratio fell to 2, meaning it took just 2 ounces of gold to buy the entire Dow. In January 1980, at gold's peak, the ratio hit 1 to 1. Today, with the Dow near 40,000 and gold at $3,500, the ratio stands at roughly 11 to 1. But if we return to the long-term trend line of 0.5, as some analysts project, we could see gold at $20,000 while the Dow sits at $10,000. This would represent a 90% decline in stocks relative to gold. Sound extreme? Consider that during the 2008 crisis, we saw a 70% revaluation in this ratio. And the economic imbalances today are far greater than they were then. History doesn't exactly repeat, but it often rhymes. And every indication suggests we're approaching a major inflection point in the gold to financial assets relationship. Section 7. What happens next? When does the public finally enter the gold market? At $3,500 per ounce, nobody is showing up. The public remains distracted by stocks, real estate, and crypto. At $5,000, there will be slightly more interest, but still minimal participation. It's only when gold approaches $10,000 that the stampede will begin. The media will suddenly discover gold. Financial advisors will urgently recommend at least some exposure. The public will panic buy at any price. And that's precisely when the smart money, those who positioned early, will be selling to them. The question isn't whether gold will reach these levels. The forces already in motion make it a mathematical certainty. The real question is, which side of this wealth transfer will you be on? At Capital Uncovered, we're committed to helping you navigate these turbulent times, to protect what you've built and position yourself for the opportunities ahead. If you found value in this analysis, subscribe now and hit the notification bell. The most important investment you'll ever make is in your own financial education. This is Capital Uncovered. We'll see you in the next video.